Hello, good morning, good afternoon. Hope you're well. It's Alex. Just doing a quick video. I think I might have missed a week on one of these. As you can tell by the background, Fortnightly uh, market review. Just to give you a brief update of what's going on, give you a chance to see my face, give you a chance to hopefully get some questions answered that you might have had questions or seen on the news that you had questions about. All right. So just to give you a bit of insight, market sentiment right now, basically trendless. Okay. There's not really any clear defined trends that's coming through and showing through. Equities are definitely bouncing up and around, up and down. Same as bonds. Okay, so bonds yields in the secondary market for bonds are affected by the rising interest rates. So nothing's particularly clear there. And cash returns as well. Well, we've seen banks going bust. I think banks are too big to fail, but if you're an investor, you don't feel comfortable leaving your cash in the bank right now. However, the strong start to the year in tech. Okay, so if you look at the Nasdaq, bull market territory over 20% year to date so far, it suggests that investor sentiment is still there for growth stocks. Okay, so technology sectors tends to be more growth orientated, higher multiples earnings per ratio. So that doesn't seem to have disappeared. And so really, I guess what the market's waiting for is the new economic cycle to start. Now, for that to happen, okay, the Fed in the US, if you look at the US market, we do that's the leading market. But if the Fed for the new economic cycle to start, okay, we need to see the Federal Reserve start cutting down and bringing down their interest rates. And that we predict that that's likely to happen definitely the second half of this year, maybe sooner. But let's wait and see. Stock market valuations, okay, not really that stretched. Everything seems fairly priced given that there was huge sell-offs previously. And of course, there's still uncertainty about, you know, what's going to happen to the financial system. Okay, because as I mentioned, the banks there, I think banks are too big to fail. We've seen the Fed step in with the likes of SVB. We've seen the central bank of Switzerland step in with the likes of Credit Suisse and provide the liquidity that banks need. So don't think we're really going to see any further major bank failures, certainly. Smaller regional banks potentially. Just be aware of where you've got your money, where your money's located, what kind of protections you're afforded on that money. Clearly, best thing to do is just remain diversified. Okay, so if equities aren't doing well or bonds aren't doing particularly well, multi-asset portfolios right now are really, really attractive. Give you exposure to some commodities, some growth stocks like tech, gives you some exposure to real estate, bonds. So the key is just to remain as diversified as possible, and certainly just keep investing as you do. If you're working with me, okay, we talk about either just dripping money slowly into the markets, or you'll always hear me say it's about being as diversified as possible and managing that risk. So I guess that leads me neatly onto what's happened over the weekend and earlier on in the week with regards to the inflation side of things. So central banks face a real dilemma. Okay, when do they stop raising interest rates and when do they start bringing them back down again and then give that economic cycle a kick? So then they have to consider in the banking crisis or the bank crisis. What's not helping is OPEC plus. Okay, so the oil producing countries around the world have decided that they're going to club together, they're going to cut production by 1.1 million barrels per day. Okay, now that's a huge amount. And if you're part of OPEC plus, you can understand why. Okay, oil's been nearly at $100 a barrel for 12 months now. They are really enjoying that price level. Why would they want to see the price of oil come down if people are willing to pay 100? Okay, $100 a barrel. So from their side, they're keeping that high. But what that does mean is higher energy costs. And does that mean it's going to raise headline inflation? Okay, and therefore making it more difficult for central banks to decide if they continue raising interest rates or if they start cutting. And with that said, OPEC Plus cutting production. Question I've been asked quite a lot is with regards to BRICS, okay, and the interdealings of these countries and how the oil production is relating to what they're doing. Okay, and the question I've been getting is US dollar, okay, is it under threat? Do we need to look at other currencies? Okay, so the first thing that I want to address is BRICS, okay. It's made up of probably some of the most corrupt countries in the world. Some of them don't even have access to international payment systems, okay, which is one of the reasons why they've come together and they're doing things between each other in a way that help benefits them. Okay, so an example that I've given to a client already. If you're Saudi Arabia and you're selling oil to China and you're taking payment in Chinese yen, and then you want the Chinese to come and do development in Saudi Arabia, and you want to pay them, well, you just pay them in the yen that they've paid for the oil, right? So it's more about inter-country connectivity for some countries that have been restricted off, and like I said, international payment systems, and for them to sort of collaborate between each other. I don't think in my opinion, I don't think US dollar is under threat. It's the only currency that international trade has done it. Okay, the example I give is you might have a manufacturer in Korea who's got to pay a supplier in I don't know, Indonesia, and they're going to pay that in dollar. Okay, there is not really, and there's no other alternative. Maybe a digital version later on down the line, but right now, the US dollar is not under threat, and it's been really, really strong for the last 100 years. Okay, so nothing to be concerned about then. China wants the yuan to rival the dollar, but in reality, the Communist Party doesn't want to relax any of the controls they've got, which means the yuan's not entirely freely convertible. So it's less desirable to hold. You hold Chinese yuan, you can't convert it. Why would you hold it in the first place? Okay, doesn't make sense. And so it's really nothing too much to be concerned about on the US dollar. The euro would be a serious contender if if the threat of the eurozone breaking up disappeared. That's not disappeared yet. We've obviously had Brexit, but I know there's a quite strong feeling in some of the other European countries that actually they're not getting the benefits that they should be from the European Union. Okay. So euro could be a contender, except for the fact that it's under threat. They're going to split apart. All right, and so the euro may rally once the Federal Reserve starts to cut rates, but ultimately, I think the US dollar is going to come out on top. Again, one of the things that say diversification, not just in investments, also currency. It's not always a bad thing. Hedging. Okay, and if that's something that you want to discuss in a little bit more detail, then definitely reach out and speak to me. One thing to bear in mind is think about the currency that you want to end up in. Okay, so for instance, if you're going to go back to the UK, you want sterling. If you're thinking about heading to, the south of France, you need euro. Okay, likewise, if you're going to go to Asia, dollars sometimes best. Okay, so just think about the currency that you're going to end up in. Okay, and then we can talk about how we can hedge against that sort of stuff later on down the line. Great, thanks very much. Really, really appreciate your time. Thanks for taking the time out to watch this. Probably a little bit longer than I wanted it to be, but anyway, have a good week. If you've got any questions, reach out, touch base with me. All right, thank you.